So for today, we covered already chapter 6 a little bit. That I think this page was the last page we did last time, which was about the makers. Let's read it again to just warm up a little bit. In March of 2020, it placed in service new 7 years property that cost $20,000. March of 2020. It elected out of bonus depreciation in 2020. So bonus depreciation, again, that gives you right now in year 2022 up to 100% bonus depreciation. But it's an election. You have to elect that. Ed sold the property in June 2022 under the mid-quarter convention. Depreciation taken on the property is as follows. And remember, mid-quarter convention was the fact that you bought more than 40% of your equipment, your asset, depreciable asset at the last 90 days of the year. If you do that, then you automatically will be forced to use mid-quarter convention. But if you buy 60% at least during first 9 months, then you can use half-year convention. But this problem is mid-quarter as it is. So the maker's first quarter percentage applies since it placed the property in service during the first quarter. They bought it in March, right? So March of 2020, it's the first quarter. So that's first quarter percentage. So we're gonna go to first quarter, 7 years, first quarter percentage. That's 25%. Although it actually sold the property in June, but June falls in the second quarter, right? So because it falls in the second quarter, then we assume it is sold in the middle of second quarter, which is 4.5 months total, 3 months for the first quarter and 1.5 months for the second quarter, which is May 15th. And so Ed multiplies the year 3 makers percentage by 4.5 out of 12 months. So the percentage is year 1, 25%, year 2 is 21.43%, and year 3 is 15.3%, 31% for 7 years property using mid-quarter. So 15.31 times 4.5 months out of 12 months, that gives us only $1,148 of depreciation expense to recognize for this year. Add them up. Your total depreciation is $10,434 minus $20,000 total cost, gives you about 9,000 something, I believe, for book value. Here, I don't know why it says 7,900. It should be wrong because 7,900 is not correct. 10,434 is correct. So 20,000 minus 10,434, whatever it is, let's say $9,000. If you sell above that, you have a capital gain long term. If you sell below that, there's a capital loss, long-term capital loss. Any question up to this point we covered last time? Okay, so let's look at one more example here. On June 21st of 2021, Nelson placed in service 7 years property that cost $40,000. Okay, in June, January, February, March, April, May, June. June falls in the second quarter, just keep in mind for that. On October 10 of 2021, he placed in service 5-year property that cost $30,000. Okay, wait a moment. So here we have 40,000 in the first 9 months and $30,000 in last 3 months. These are the only properties placed in service in 2021. Section 179 was not taken on either property. We're gonna go over Section 179. Nelson is considered to have placed in service 42.9%, which is 30 out of 70, right? And we said it should be more than 60% in first 9 months. But they put 42% of personal property in the last 3 months. Therefore, the mid-quarter convention applies to all personal property plus placed in service in 2021. Nelson used the mid-quarter tables to compute depreciation on maker spaces. He continues to use the same mid-quarter table to depreciate these properties. So the year is just showing you that for mid-quarter convention, that was in your book, maybe in, I will tell you what page. Page maybe 602. Yeah, page 6-6, which is section 602.03. It says that if they purchased over 40% of the depreciable personal property during the last quarter of the year, then they have to use mid-quarter. Purchased over 40%, they have to use mid-quarter. So here we purchased 42.9%. That's over 40%. That's why we have to use mid-quarter. Same fact as in example 6, except the Nelson placed the 5-year property in service on September 30th, 2021. Okay, that's good. Since at least 60% of personal property placed in service was placed in first 3 quarters, less than 40%, the half-year convention will apply. Okay. So straight line, remember I said makers has a straight line option, which is good to use it because that's kind of matches with straight line in bookkeeping process. And in your bookkeeping, if you choose to have a 0 salvage value, will be literally matching this. So straight line makers use the straight line method instead of accelerated method. Accelerated method in accounting, we call it the most common one is double declining balance method, which is 200% accelerated method. But straight line is much easier and much more common. So you use original cost, total cost, minus 0 salvage value, let's say, because in tax we use 0 salvage value. That gives you depreciable base divided by useful life. That gives you straight line depreciation for each year. But no matter what, it says the convention, the mid-year convention and mid-quarter convention, it will apply, doesn't matter. So here is an example. On June 1st of 2021, a taxpayer places in service 5-year property costing $10,000. The half-year convention applies to all personal property placed in service that year. The reason is because they purchased, majority in first 9 months. The taxpayer sells property on January 14, 2024. So still, if you sell it in January, still you have to follow that half-year convention, okay? A comparison of regular accelerated makers and straight line makers follows. An election not to claim bonus depreciation on 5-year property was made. So they didn't use bonus depreciation. So in a regular makers, first year is 100% divided by 5 is 20%, 20% times double declining, 200%, that's 40%. 40% for half-year convention goes back to 20%. So that's the 20% that you see here. But in straight line, you say 100% divided by 5, which is 20%. 20% times half-year convention, that's 10%. 10% times $10,000, that's $1,000. Make sense? So the ratio percentages here is given in the table, but in the straight line, it is very simple math. 100% divided by 5 years useful life, that's 20%. So 20% you're gonna use all the time. Just in year one, you use half-year convention, and last year of selling, it will be another half-year convention. So 10%, 20%, 20%, and again 10%. And that will be 6,000. So as you see, under straight line method, you have less depreciation overall. And that will hopefully match with your type of business income that you have. If your business income is steady, it's better to use a straight line method. If you have a business that has a lot of income in year one and year two, then you definitely like to use the accelerated method because it provides you higher tax write-off. Okay, if that is good, no question, then same fact as example 8, except that the mid-quarter convention applies to personal property placed. So because it's mid-quarter, they purchased this in June, and June is, you have to look in the table, mid-quarter, 5 years property, and that is five years property, and they bought mid-quarter. That's 25%. Let me show you the page so you see where this, I'm trying to show you where this 25% is coming, okay? So I'm gonna go back to page 6-7. So here is 5 years property. You see 5 years property purchased in the second quarter. Year one is 25%. Year two, 30%. Year three, 18%. So, okay? So that's 25%, 30%, 18%, and 11.37%. The only fact here is they sold it in January. January is the first quarter. So first quarter is 1.5 months. Middle of first quarter is 1.5 months out of 12 months. That's the only depreciation expense you're gonna recognize for that year, $142. However, for straight line, we have 100% divided by 5 years useful life. That gives us 20%. 20% times 7.5 out of 12 because they bought it in the third quarter. Yes. My point of view, it should be 4.5. I don't know why it says 7.5. So it might be a mistake. The good thing about these depreciations, let me tell you, you're not gonna do this like the way we are doing right now. We are right now just trying to learn. All you need to do in a software, enter the right information. Say, I have an equipment, but you have to say what type of equipment. Is it 5-year property, 7-year property, what? If you choose those, and also calculate the 40% and 60% to apply the mid-quarter or half-year convention, then the rest, the software knows the date of purchase, knows, let's say, the date of sale. You enter those dates correctly, the software will do it properly for you. And also every year, the software with your tax return, it will provide you a schedule of depreciation. So you can see what was the depreciation this year, and also it shows a upcoming next year depreciation in the worksheet. Of course, some softwares might be a little bit different, but that's what my experience shows. The election to use the straight line method can be made annually for each class of property. So if you like to use a straight line, you have to choose an election on that. For example, the taxpayer that elects straight line method in 2022 for 5 years property must use the straight line method to depreciate all 5-year property placed in service in 2022. Make sense? So if you use straight line, then you have to use straight line for all those 5-year property.
That's interesting because don't they switch it on the other one from at some point?
For what?
It switches. Is it when you do maker or whatever, it switches on like the 3rd or 4th year to straight line?
Oh, that thing, it says accelerated method. If you use accelerated method, it will keep using accelerated method until a point in time that your straight line depreciation will be higher than accelerated, and then they will choose the straight line at that point. And again, the software will automatically do it for you. So you don't have to remember that. So class by class basis, the election is class by class. Taxpayers that use straight line method to depreciate 5-year property placed in service in 1 year does not have to use it to depreciate 5-year property placed in service in another year. Just in the same year, if you use 5-year property as a straight line, all your 5 years property will be straight line. Same thing about 7 years. Same thing. So Jones Company placed in service the following properties during 2021. Equipment, 7 years. Furniture, 7 years. We know that, right? Delivery van, any type of car is 5 years. Warehouse, commercial real estate property, that's 39 years. Office building, commercial real estate property, that's 39 years. So those are the things that you have right now. If Jones wanted to use straight line makers to depreciate the equipment, it must use straight line method to depreciate all 7 years property placed in service during 2021. So if you choose 7 years to be straight line, every 7 years will be straight line for that year only. John's decision to use straight line to depreciate 7-year property placed in service during 2021 does not affect the depreciation method it uses to depreciate 5-year property. So 5-year property is different story. He has to choose on that one separately. Or any real estate property during 21. Also, it's decision to use straight line makers to depreciate 7-year property placed in service during the 2021 does not affect depreciation method it used to depreciate 7 years property, vice versa. In 2022 or any other tax year. So you are just making a decision for that specific year, for that specific class. Got it? Has nothing to do with next year, has nothing to do with another class.
Why are there's so many different methods. Like, Jesus. I don't get how you're supposed to decide without running like each one in the tax system. I mean, once you get it, maybe after you've done it a bunch of times, but like, how would we know which is the best one for someone to do without running it every time?
The decision maker is you, that you prepare tax return. Your job is to reduce the tax as low as possible.
Right. That's what I'm saying. Like, don't you have to run it every possible way to find out what the best option is for them?
Okay, so first time it's gonna be a little bit slow motion for you, but overall you are thinking that how much income do I have? How much depreciation do I want? And if my income is high, I am more going towards accelerated depreciation. If my income is normal and steady, I am more entitled and favor the straight line method.
Okay.
Make sense? That's the main thing. So again, in my business, my income was not crazy high, but steady. So guess what? Every property I had, it was straight line method, no matter what. And I used straight line for my bookkeeping too. And that was a good thing because my straight line and my bookkeeping depreciation was same. But since you like so much different methods, let me show you another one.
I saw that.
We have alternative depreciation system also, which differs from makers in the most properties have longer recovery period. In addition, the straight line method will apply. So you're gonna use straight line, and also you're gonna have longer years. And again, why do you want alternative? Because maybe your business is really not that much income coming up every year, and it's gonna be steady for so many long years. So you wanna use ADS because it gives you a little bit less depreciation, but it's gonna continue for longer time. So you are doing your tax planning. The whole idea is tax planning. How do you want to manage your taxes over this year up to next 30 years? Okay, so the half year and mid-quarter convention will apply anyway, doesn't matter. And so in general, it says office furniture, fixtures, and equipment. Remember I said makers is 7 years for office furniture, right? That in ADS, it goes to 10 years. So it gives you longer time to have a depreciation on office furnitures and fixtures. Automobile, trucks, computers, printers, electronic, those type of things, those are 5 years, and ADS is also 5 years, so no difference on that. But copier, calculator, and typewriters, they are 5 years in makers, but you can get 6 years in ADS if you like to use them. Heavy general purpose trucks, again, automobile, I said it's 5 years, but if you want to use ADS for your heavy general purpose trucks, heavy duty one, 6 years is the option.
Why is there that difference?
To provide you a little bit more depreciation if you want to for longer time period. Again, that depends on your business income. Everything is about business income and how you want to manage that business income and write off your depreciation expense from your income so you pay less income tax and make it manageable to pay income tax.
But there's no change in the property class, right?
No, it's just using,
Different.
in your software, there is a box, it says ADS.
Oh.
If you want to check that box, then you know what ADS is at least. As long as you know what ADS is, that's the whole thing. Then you can check that box and make it a little bit longer depreciation.
Is it still like,
So here says 12 years for anything that is not designated in here. Yes.
is it still, you still have to, if you do 7 years, you have to do all the 7-year plates in service under that method?
No, no, alternative, no, for alternative, I believe you can just go with, asset. Choose the asset and use ADS for that specific asset. Okay, let me read this. Let's read it. Let's see. So taxpayer makes election to use ADS annually. So on a class by class basis. So your answer is yes. If you use 7 years ADS, then every 7 years will be ADS. Once the taxpayer elects to depreciate specific class of property using ADS, the election for the class of property cannot be revoked. Straight line ADS must be used to depreciate listed property used 50% or less for business. So if you have a property that you use 50% or less for business, you have to use ADS. Okay, there is one more. Remember I said accelerated cost recovery system. Normally you use 200% accelerated. But let's say you have an equipment that is not depreciating that fast, like 200%. So the other option here gives you 150% accelerated. Instead of double declining, you use 150% declining balance method. Okay. In general, you just to not scare you because of all this stuff, just keep in mind the general is maker's straight line is the best. It will provide you a steady depreciation expense for many years, and it will also match your bookkeeping using straight line method. And straight line method is the most common used depreciation type in businesses overall.
Quick question. I forget. Real estate property, real property.
Straight line for real estate property is residential 27.5 years. For commercial is 39 years, straight line.
Say it's 39 years.
Yeah, I think it might come later on. But for now, since I kind of remember it, I tell you.
Residential 27, commercial.
27.5.
Commercial 39.
Commercial 39. Don't ask me why. I don't know. Natalie placed a desk in service to recover the cost of desk and all other 7 years property placed in service during the year. Natalie can choose from the following methods. Either use bonus 100% for year 2022, which in year 2023 is 80%. He can choose also, let's say he doesn't elect bonus, he can choose makers 200% declining balance over 7 years because it is a desk. Okay, desk is furniture. Furniture is 7 years. So 200% or 150% declining over 7 years, elective on property class basis, or straight line over 7 years, which is again, furniture 7 years, straight line, that's the best, I believe, elective on property class basis, or she can say, no, I want ADS straight line over 10 years for this desk. So now you have to choose, do you want a lot of many years of depreciation expense in your tax preparation? Then use, looks like ADS gives you the longest one. If you are a business that you are making so much money right now and you really need depreciation expense to use, then use 200% decline. Okay, so here it says the information. It says often assume that taxpayers should take the maximum deduction allowed at the earliest possible. However, a taxpayer currently in a low tax bracket may expect to be in a higher tax bracket in future. So you have to see what's going on. Are you a low tax bracket, high tax bracket? This particular taxpayer may benefit more by delaying depreciation until higher tax bracket years coming up in future. Okay, so let's talk about Section 179. Section 179, it will offer you the first option is Section 179 and then bonus depreciation and then regular makers that we are doing. So Section 179 first, choose it or not. Bonus depreciation second, choose it or not. And then third one, whatever is left is regular makers. There are a few tricks on this. So taxpayer can expense up to $1,080,000 of Section 179 in year 2022. In some places, you might see $1 million. That means it's not updated. So if you see somewhere it says $1 million, that is 2021, I believe. 2022 is $1,080,000. So up to that amount, you can expense it up. The Internal Revenue Code defines Section 179 as tangible Section 1245 property and qualified real property. Qualified real property is the real property like businesses, land, not land, I mean business, building, real property, or Section 245, 1245 property is like, regular stuff like copy machine, equipment, those type of things. Used in the business, yes. Okay, that's also. Therefore, depreciable personal property used for investment is not Section 179. So if you have something for investment, you cannot apply Section 179 to it. Section 179 is technically for business purpose, okay? However, both new and used property that the taxpayer buys for use in taxpayer's business is eligible for Section 179. Used or new doesn't matter, but should be business. For years in which 100% bonus depreciation is in effect, Section 179 has limited appeal because most people that they want a big depreciation, they use bonus depreciation. Why? Because in a bonus depreciation, there is no limitation, but 179 has a limitation. And one of them is right here. It says $1,080,000 expense. Let's say what else?
What is where it says predominantly?
Predominant, that means mostly used for business.
And what would be not predominant?
Completely business. That's the other word. But if you say predominantly business, that means
business sailors.
It might be personal, some area. But if it is personal, then you have to calculate what's the percentage and deduct that.
Okay.
You can only use the business portion of Section 179. You cannot say, oh, because this is 60% business, then I'm going to use the whole thing for Section 179. No. If it's 100% business, yes, Section 179 is 100% applicable. If not, then not. So here is the area that I like to maybe. The property must be used more than 50% in trade or business. Only the business attributable, the basis attributable to business might be expensed under section 179, not the personal percentage. Okay, one more thing. Here says in 2018 and later, qualified real property consists of improvement in the interior of non-residential property also. Those are, we call them real estate improvement that you do inside the building. Improvement made by owner or tenant on an office building, let's say. You can apply section 179 to that. It also includes replacement of roofs and air conditioning. Prior to 2018, qualified real property consists only of improvement to the interior of non-residential real estate property if made pursuant to lease or retail, like restaurant building or something like that. But now, after 2018, it will apply to interior, roofs, air conditioning. Section 179 will apply to those. And it says the amount of 179 will be reduced dollar to dollar for anything above $2.7 million of equipment purchase. We might see an example down there. So we call this investment limitation, which is $2.7 million. For example, taxpayer who placed in service $3.2 million of Section 179 property during the 2022 would be allowed to expense up to, okay, that number, remember I said 1 million is not good, it's 1,080,000, okay? So 1,080,000 minus, that is wrong. It should be 1,080,000 minus, what is 3.2 million minus 2.7 million? That's $500,000 extra, right? So dollar to dollar, you reduce that. So $500,000 extra, you dollar to dollar, you reduce $500,000 out of $1,080,000, and the answer is $580,000 expense is the maximum he can do. Got it? So why they do this? The reason is because they want to help those companies that they are not huge, rich companies that invest millions and millions of dollars on equipment. This is mostly referring to companies that they are mid-sized type of companies, spending up to $2,700,000 annual basis for Section 179 properties. So here is an example. On February of 2022, Low Enterprise placed in service equipment that cost $2.8 million. So that's more than 2.7, right? So dollar to dollar, you will reduce that. The equipment is 7 years maker's property. Since Low placed in service more than 2.7 during the year, it can elect expense up to how much? Instead of 1,080,000, it can elect only up to 980,000. Why? Because 1,080,000 minus 100,000, the difference, that gives you only $980,000 left that you can, up to that amount, expense it under Section 179. Remember, Section 179 comes first, bonus comes second, and makers is your last lifeline to use for depreciation. Now, if like this company used 980, right? and has how much left that didn't use for section 179? 100,000, right? So it says somewhere here. However, this carryover is subject to the section 179 limit that applies to the next year. So that $100,000 can be carried over to the next year and the year after that, for next few years, as long as it takes. Okay, here is an example. Same fact. As example 12, except that lowest business income limitation, taxable income from the business after all other depreciation has deducted is only 67. So the income is how much? $67,000. So that's your limitation. You cannot say, oh, I'm gonna use I'm gonna use this $980,000. I'm gonna use that. No, you can't, because if your income is only 67,000, then guess what? You're gonna use only 67. The rest will be carried over forward next year. After depreciation on 1820, so the carry forward, sorry, remember I said carry forward 100,000 a year? That's not carry forward. The carry forward is the amount, the difference between what you are allowed to do and what your income is limiting you to do. If your income provides a limitation on your allowable 179, then you can carry forward the rest. So $912,000 will be disallowed and will be carried over 2023 and years after that.
How many years after?
It doesn't say anything, so I'm assuming you can keep going. Sometimes carry forward has no limitation. Sometimes in some areas they put a limitation. Let's say 5 years limitation.
So what happens if it's a similar situation and you sell it? And you still have some balance with the carryover?
Oh, if you sell it, then it's good because you didn't depreciate it. That means your basis is very high. If your basis is high, then you might have literally very small capital gain or no capital gain or capital loss, because your basis staying high is good. If you want to sell something, you want big base. Big base means most probably you're going to have a loss. And if you have a loss, then you can write it off, right? The problem is base is low and your selling price is high. If that happens, then the difference between your low base and high selling price, that is a capital gain, which you have to pay taxes on it. So keeping a high basis is good. Make sense? But there is one thing. Maybe you say, you know what? I don't want to depreciate. You cannot do that. You don't have that option. Say, oh, I don't want to depreciate for next 5 years. I want to keep it for future. No, you can't do that. Either use it or lose it. Okay, so here is probably a form. Here are the things that the situation, they purchased 2.8 million, 2.7 million is the limitation. So there is $100,000 reduction in because of that limitation. So they are allowed to spend up to 980, but because the income is only 67,000, so the remaining 912,000 will be used to carry over. Okay, so here is the form, depreciation and amortization, which will be populated in your software. That's the limitation for section 179 if you choose that. And then 2.8 is the total assets that you purchased minus 2.7. That is $100,000 reduction. So 100,000 minus 1.180, it's 980. But your income in line 11 is creating a limitation, so you cannot use this 980 at this moment. So the 912,000 remaining balance of your section 179 will be carried forward to next coming years. And here is the basis for depreciation. They have a 7 years property. They paid $1,820,000. That's the recovery period. And HY means half year convention. Used method number 2, whatever the method is. And here says, showing you the straight line, all those options that you might have and you want to use. You see here says residential rental property is 27.5 years. And that's a straight line. And residential or commercial, doesn't matter, is always mid-month convention. Always mid-month convention. That means if you buy in January 1, they will assume you bought it in January 15. If you buy in December 3rd, they will assume you bought it in December 15th. If you sell it in March 4th, they will assume you sold it in March 15th. Got it? Mid-month convention. So here is, as a default, it says residential rental property is 27.5 years, straight line depreciation, mid-month convention, straight line. Non-residential property, which is commercial, is 39 years. So 27.5 years and 39 years. Alternative, the ADS is, we have as a default some alternative, which is 12 years, straight line. We have also 30 years and 40 years. I think 30 years alternative belongs to residential property, and 40 years, I think it will apply to commercial property. Mid-month, of course. Real properties are mid-month.
How come the 12-year one doesn't show the mid-month thing?
12 years, if you remember that we were studying, we just said, besides that few options that they said ADS, if it's not listed over there, anything else will be automatically fall into 12 years. Got it? So 12 years is the last option for, if it's not furniture, it's not automobile, then you say, okay, my equipment is not here, then they say, okay, that falls into 12 years. So it's like probably machinery, let's say. Machinery maybe falls in 12 years. Okay, so we got the idea. Okay, so what is this? Here says, what is listed property, just in case you hear that? Those are things that might be also personal property and business related property in the kind of mixture of it, I believe. Commonly includes vehicles, computers, printers, related equipment effective for property placed in service before 2018. Listed property that taxpayer does not use more than 50% of the time for business does not qualify for regular accelerated or bonus depreciation or section 179. So if you are not using it for more than 50% for business, you're gonna lose that accelerated bonus and section 179 options. Instead, each property must be depreciated under ADS using straight line method. So if the property you are using, let's say 60% personal, 40% business, that 40% of business that you are using has to go through ADS straight line. Half-year convention or mid-quarter convention will apply no matter what. Any property that must be depreciated using ADS, such as listed property not used predominantly in a trade or business, does not qualify for bonus depreciation and section 179. Okay. Those are like what? Personal passenger automobiles, motorcycles. Those are personal use most of the time. Truck, business, boats, airplane. It can be personal most of the time. Entertainment via recreation and amusement, like cameras and VCRs. Communication and stereo equipment. You might have it for your personal use, but also you are using it with some percentage for business. So maybe your client say, oh, can we write this off? Yeah, we have to establish what's the percentage of use. So automobile is one of the most common one. And you have to establish a mileage use for business in relation to total miles use. So that's why when you have a client and he says, I have a car for my Schedule C, one of the question is, how much mileage did you drive for the year? The next question is, what's the business mileage that you drive? That means the rest is personal. Let's say you say I drive 10,000, and then said how much is business? Let's say 3,000. So okay, so 3,000 is business, 7,000 is personal. Only you can depreciate up to that 30%. 3,000 out of 10,000 is 30%. So 30% use. And again, be careful. Taxpayers must be able to substantiate the amount, time, place, business purpose of transportation expenses. IRS is super picky about this. I mean, that's the first thing they're gonna come after. So if your client says, I don't have mileage log, which happens during VITA program, if you don't have mileage log, then I cannot do it. Without mileage log, there is no basis for your tax claim. For automobile and other vehicles, they must be established both the business investment mileage and total miles the vehicle was driven. They do this by keeping adequate records by producing evidence that supports statements they appear. So you have to have an app, a log, something reliable so you can establish your expenses. Yes.
Could that be just like a handwritten log?
Yes, but it has to be very specific. Like today, October, whatever, drove 8 a.m. from this address to this address, 10 miles.
And then, well, my work, what they've done to reimburse drivers is they print out the Google Maps and it shows that it has to be the lowest of the 3 options or whatever. But the mileage, and then I guess they also probably run that, right?
Yeah, there is some apps that gives you the mileage. mileage or something like that, what they call it. There are a few apps that you can use to have a digital records of that, which is okay. Yes, they will accept it. But you have to specifically say what in that address that you drive, what's going on. You cannot go to your cousin and say, oh, I drove to that address, it was a business. It has to be established customer, the reason you drove. So you have to have invoice, you have to have other things to prove it. So there are a few examples here. Let's read this one. August 9, Tom placed in service new video recording equipment with a regular recovery period of 5 years, which is most of the times, right? And then 9 years ADS recovery period that cost $4,000. This is only property Tom placed in service in 2022, so there's nothing else. So the half-year convention will apply. Tom used the equipment 60% of time for business, 15% of time for investment, and 25% of time for personal. Since the business use of the equipment exceeds 50%, accelerated depreciation method can be used to depreciate the 75% combined business and investment use. So that's 4,000 times 75% business and investment. That's $3,000 business investment basis. That's the only thing you can use in your depreciation, 3,000. If an election out of 100% bonus depreciation is not made, Tom may claim $3,000 bonus deduction for the basis attributable to investment and business use. One thing that I want you to emphasize, election out of bonus. That means if you do nothing, 100% bonus will apply. Make sure you check the box. Say, I do not want bonus. If you don't check that box, bonus will apply automatically. It's a default. Got it? So here says, if an election out of 100% bonus depreciation is not made, that means automatically it will apply 100%. ADS is not required because business use exceeded 50%. So it's not necessary to do ADS. If business was less than 50%, then ADS will automatically require for you to do. Assuming he elects out of bonus depreciation and business use exceed 50%, Tom could elect to expense $2,400, which is under Section 179, which is 60% of $4,000. That's Section 179 election. So after bonus comes Section 179. If you choose not to use Section 179, then the next option is makers. Makers is the last option. So you can use makers for depreciate whatever is left.
Well, you got confused. I think earlier you said it was 179 and then the bonus, and then, or does that?
179 first, and then bonus, and then yes. But here says, assuming he never use bonus. Right now, the bonus is 100% in 2022. That is something that is kind of take all the options out, because if you use bonus, then there is absolutely nothing else to think about, right? But assuming you do check the box and say, I don't want bonus, then next option comes 179, if you want it or not, then it comes after that makers, the last option. But overall, Section 179 is at top of the list because bonus didn't even exist before. Now we have all of a sudden 100% bonus last few years. Section 179 is much older rule compared to bonus. Bonus all of a sudden popped out for a few years, and starting 2023 is going to go down 20%, 20%, 20%, 20%. So it's gonna disappear eventually. But Section 179, it is kind of established type of thing in the tax.
When you say makers there, that includes like straight line makers, alternative.
That's here you see, let's say you use Section 179, which is 60% of 4,000, that's 2,400, right? What is left? The 600. So the 600 left, that's the only thing left that you're gonna apply to as a basis for your maker's calculation. But if you don't use that 2,400, then you have the whole $30,000 bonus and business investment to use for calculation of your makers. But
7 years, that's 7 years, right?
7 years, yeah.
And then,
So there's another example, you can read it. I don't have time. I want to skip a little bit from here.
But you do that each year. Each year you're split 60, 40, year one, and then different methods.
The business use? Yeah, the business use, because you have the equipment for that year and you establish the business use, I think that's what you establish it. And you
Year by year, 60, or you do 60, depreciating 60%, and then the 40%.
40% is personal, right?
Also, it's a different category.
Personal, you can depreciate that.
Yeah, different line item.
Yeah, personal, you can depreciate. It's personal use. So if you buy a car for your personal use, you can depreciate that. Which some client come to you and saying, how about my car? Can you depreciate that? No, I have a friend, he's depreciating his car. Why you cannot do that? They try to show you that you don't know what you are doing.
How about sole proprietor using the car for business use?
In a sole proprietor, if you have a Schedule C, right?
Oh, yeah.
When you put the car inside in your Schedule C, it says, how much mileage did you have for the year? You say 10,000. The next question says, how much mileage do you have for business? And then you say 3,000. Then, okay, 3,000 out of 10,000, that's 30% use. The next question after that says, do you have records for your business mileage use? And then you have to say yes. If you say yes, that means you have it. If you don't have it and you say yes, that means you're lying.
So if they ever audit you, you're not good.
Yeah, because in the sense, here you said you have the record. Where's your record?
They have the mileage, the cents per mile, but
Yes, cents per mile every year is changing.
58.
Again, it's 58 cents or whatever it is, or 62 cents or whatever it is. Every year is changing, so I'm not memorizing it. Plus, sometimes first 6 months and the second 6 months are different. So in your software, we say, okay, how much was your business mileage? You say 3,000. It says, okay, how much was the first 6 months of that 3,000? And guess what? You have a record, right? So it should be no problem for you to tell what was the first 6 months, what was the second. And that happens only if they have two different rates for first 6 months and second 6 months. Okay, so you can read this part, I believe. Here is the listed property, part 5 of that form, 4562. You see here it says video equipment. You see it's filled up. It shows the date of place in service and what is the percentage of business. Let's say 55% is business and investment use, let's say. And here says cost, what is the cost basis? And because here says 55%, then here says the basis for depreciation for business is only 2,200. It is a 5-year property, straight line, and depreciation deduction will be $220. Let's see. That's about it. So let's see what else I have here. We kind of have a lab time, so I want to spend time on the lab. For luxury automobiles, there is a table given how much you can depreciate for luxury automobile, and you have to follow this. You have two options. Just as you see here is let's say 2022. It's 11,200 placed in service, but if you choose the bonus, it will add another $8,000 to it, and it will make it to 19,200. It says tax law limits the depreciation of vehicle for business, even those use 100% for business. So even though if it's 100% for business, it still there is a limitation to how much you can depreciate. And what else? Let's see. Oh, there is also this applies to cars that they are 6,000 pounds or less. If there is heavier than that, there is another rule for those type of cars, more than 6,000 pounds. How much is it? If it's more than 6,000 pounds, here, over 6,000 pounds, the limitation is like a SUV or something like that is $25,000. Okay, so that's one thing. And here there are also examples about those cars that you put in service. Let's read just one of them quickly. In August of 2020, Paolo placed in service a new car that cost $40,000. Its half-year conversion applies to personal property. Paolo placed in service in 2020, and half-year conversion because it was the first 9 months. Okay, Paolo used the car 70% for business. Therefore, business use cost of the car is $28,000. Right? It's a $40,000 car, but it is 70% business, so 70% of 40 is just $28,000 depreciable base. Since business use exceeds 50%, bonus depreciation and regular makers were taken on the car. Paula used 2020 column from figure 6-5 to compute the luxury car limit. The depreciation calculation is follows. 2020, lesser of 100% times 28,000 or 70% times 18,200. You remember it's 18,200 limitation on the previous page. So which one is lesser? You use that 12,740.
Does that tell you somewhere what is considered a luxury automobile? I'm not sure a $40,000 car is still a luxury automobile these days.
It says luxury, and then it says kind of everything falls into that limit nowadays. all cars are all of a sudden launching. Now, the only problem is weight. Weight is the thing that you have to focus. Is it 6,000 pounds or less, or more than 6,000
I gotta
pounds?
get a bigger scale and.
Yeah, because if it's more than 6,000 pounds, you can deduct 25,000 for the year. Okay, so for year one, it's 12,740. And again, in year two, less of 100%, multiplied by 28,000 minus whatever you depreciated previously, accumulated depreciation. So 28 minus accumulated depreciation, whatever it is, times 100%, or 16,400 that it's given in the table, whichever is low. So it looks like this is low. And in 2022, zero, all bases are left. Okay, since there is nothing left, so there is nothing to depreciate in year three, so-called. So the whole car will be depreciated in two years. Okay, so
After the depreciation is paid, it's still business asset.
yeah, it is a business asset, yeah. But if you use a standard mileage and you have log, in most cases, it's much easier to do that. And you don't have to also use so-called the actual expenses, like oil change, brake job, those type of things. You don't have to use it. But depreciation, you do it anyway because it's a portion of your car is business purpose, and that the cost of original cost of your car, you want to depreciate that part. Yeah. And also, you sometimes lease a car. So if you lease a car, there's a specific calculation for the leased vehicle. Here is the lease type of thing. If you lease it, there's an inclusion amount, because most of the times the car that people lease, they want to lease a luxury car, so they have a lot of more so-called depreciation for the lease car. So here it says there's an inclusion amount that IRS made it up for some reason. It says if your car is over 60,000 and up to this amount, there are some dollar amounts that you have to take it out of your depreciation amount. And that's, again, will be done automatically with the software. But if you want to read it as an example, there's an example here just to see it. But again, you don't have to memorize this. All you need to do is just read an example and just see how it works. Let's take the break, 5 minutes, and come back for doing a lab and preparing the taxes. I'm gonna print another scenario for you from the practice lab. And also I wanna see if you are doing the first one or not. Okay, so I suggest to go to link and learn certification.com. And after you go to this website, go to practice lab and enter the website initial password, which is Train Pro Web. And then enter your username and password to sign in. So you go to practice lab, this is where the software is. And we did practice return number 1. Hold on to those answers. It might come handy later on in your quiz. Now we are going to go to practice return number 2. And these are the possible outcome at this tax return. So we have a refund of looks like $8,634. But I'm gonna go to attachment and try to see. I have 2 attachments here. One of them is the tax return itself. As you see, the whole tax return with all schedules and worksheet. And here is the e-filing signature authorization. And here is the form 1040 and the rest of the schedules at the bottom. So here is, looks like in this scenario, we have $62,000 income. We have 2 dependents. And taxable interest is $242. Ordinary dividends, $315. I don't know what that $24 is. It's a married filing jointly, I believe. And therefore we have 25,900 standard deduction, and the taxable income will be only 36,733 based on about 12% tax, I believe. That's 39,066. And what else I can see here? Child tax credit is 2,466 child tax credit. 1,500 comes from Schedule 3 for some reason. And therefore we have no tax due. However, in the W-2, we have $7,600 of withholding. And that will be refundable to you, to the taxpayer. We have additional child tax credit left over of $34 that we couldn't use above in here. In line 19, we couldn't use it. So since we couldn't use it, we can use it $34 right there. And American Opportunity for education tax credit is $1,000 refundable. So most probably this 1,500 here, I see it is because of American Opportunity tax credit. And because of that, $1,000 is refundable maximum. So they're gonna get that maximum refund. So 1,034 plus 7,600 ends up to be 8,634. So hold on to this for this moment, and then go to the next attachment. I'm gonna make a print of this for everyone, but just so in case you wanna see the digital version, it's right here. The reason I'm showing you, just you know where it is. So let me print this for you, and you start preparing taxes in the practice system, okay? We are good? Okay, so I'm gonna stop recording at